I was listening to a podcast from TED Radio Hour, and a woman from Stanford was being interviewed. She has studied ants, and there's about 12,000 different types of ants around the world, and ants have been on this planet for millions of years. And there's no central control for ants. The queen does not control all the other ants. The worker ants don't control any other ants. There is actually no central control for any ant colony. All queens do is lay eggs. And I believe all of the ants within I don't even know what it's called, an ant colony, are women and are female, and the ones going out are male. But what's interesting is every ant has its job. And one of the things that ants have figured out how to do over the last million years is survive. And the way they survive is very, very interesting, and it's almost clever because it's so simple. All they do is when they meet another ant, they touch antennae, and they're not necessarily communicating anything with the antennae. What they're doing is they're figuring out how many ants they're coming in contact with in any given amount of time. So if fewer ants are coming back to the colony, then fewer ants go out, because that means there's less food out there and there's less water out there. So the ants know to stay home and wait. And when an ant is going out and it's being met by many more ants, then many more ants go out and continue looking for food. And it's an incredible simple system with no central control. But anyone who's ever been around ants know that they survive. And I'm talking to you about this because the stock market has no central control. Now, the Fed or the Japanese central bank or the European central bank or any central bank thinks they can have central control over the stock market, but no one does. There is no central control over the stock market. The stock market is hundreds of millions of free-thinking humans putting their money where their mouth is, trying to figure out what the next 6 to 12 months looks like going forward. So if they think it looks slightly better, they will go in and put some more money into Walmart or Microsoft or whatever investment they're looking at, because they feel a little safer about the future. And if they're feeling a little less safe or less safer, even if that doesn't make grammatical sense, about the future, they're going to not buy as much. They may take some money out, they may not take some money out, but the first thing they're going to do is they're going to stop buying. And in a bear market, you don't need a lot of selling, if any selling. What you need is just an absence of buying. And typically that is the beginning when markets turn, that the buyers don't really show up anymore. And when they do, they don't show up in large amounts. And eventually then the sellers show up and things really turn for the worse and we go into a bear market. So with that, I want to talk about something that is really interesting that is going on right now in this current environment. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is not so clever, called negative rates. So, about 27% of world GDP on this planet is happening within economies that have negative interest rates. So if you give your money to the government, they will give you back a little bit less 1 year later or 2 years later or 5 years later and even 10 years later. So people are so worried that they're not even worried about making money on their money. They just want their money back, but minus just a little bit. So the question should be, well, RC, when was the last time, like what happened the last time, a quarter of the world went into negative interest rates? And this quarter of the world, this is not, emerging markets, Zimbabwe, Central African Republic type countries. These are developed countries that are going negative. So the question is, what happened the last time developed countries went negative? Well, the answer is it's never happened before, ever. This planet's 5 billion years old, and we've never had negative interest rates. Japan's never, ever, ever had negative interest rates. Germany has never had negative interest rates. And the US has yet to have negative interest rates, but Japan does have negative interest rates. And in Germany, they touched into the negative territory on the 10 years, on the 10-year treasury. So the question is, how do we make sense of this? Well, look, the first chart I want to show you is the yield of the 10-year treasury in the United States. So as of today, it's about 1.75%. So you give your money to the US government, and they're going to give you 1.75% a year for 10 years. Woohoo! And as you look at the screen, you can see that the yield dropped below its 2015 low and started competing with the 2013, actually hit about the same level as the 2013 low, and we're back to 2012 lows, which were historic lows, never before. Now look, it probably won't move in a straight line down, back down to 1.4, okay? But this is moving down. And the blue line on the screen here, the blue line is the 70-day exponential moving average. And as you can see, at best it's choppy and zigzag, and I don't really know what it's going to do. But it kind of peaked here, at least over these 4 years and 3 months. It peaked at the beginning of 2014 and has been falling and just broke below the 2015 low. There was no 2014 low. And the 2013 low, it matched. So rates are going lower. Now, rates go lower when people are scared. Just give me my money back. I just want my money back. Forget about having it make anything. Just make sure I get it back. That's what's going on. But it gets even worse, because then you go over to Japan. And if you look at this price chart, same length of time, the 70 exponential moving average, the blue line, is clearly moving down and to the right. And just recently, last week, the Japanese 10-year yield bond, the yield on the 10-year bond, it went negative. So somebody, not just one person, but people gave the Japanese government their money, and for that, the Japanese government is going to give them back a little less of their money each year for the next 10 years. Now, what's crazy about this is people are flooding into the Japanese yen, even though they just made their rates negative. I mean, could you imagine Kurudo over in Japan thinking, okay, we're gonna make our rates negative, which is going to affect our currency, and that's going to help us drop our currency so we can export more and so we can help our economy. And days later, the Japanese yen is breaking out of a channel to the upside. I mean, what does Kurudo need to do in Japan to get people out of the Japanese yen? But here's the thing. The Japanese yen is a place that people panic into. People historically have panicked into the Japanese yen and the US dollar. And really, people have panicked into their local currency. That's what's happening. People are concerned. So when you see rates hitting negative like they just did in Japan the first time ever, that's telling you something about the mood of what these hundreds of millions of people are doing as they look at the stock market, as they look at the future. And they're looking over into the future and they're saying, I don't know. Things are more uncertain. And it's just not over in Japan or over in Asia. If we jumped over to Europe and we looked at Germany's 10-year yield, it went negative in April of last year, 2015. Now, it only went negative for a day, but it went negative. That day, people gave money to the German government, and the German government said, thank you, we'll give you a little bit less back each year for the next decade. And then as you can see on the screen, the yield went amazingly from 0 or negative up to 1%, extremely quickly, 2 months. And then it's been falling ever since then. And now it's down to about 0.19, 19 basis points. This is how concerned people are right now. When people move money into the bond market, it's because they're concerned about the future. Now, I put all of these 3 bonds together, their yields, just so you can kind of look at them over the same time period. Again, the time period's about 4 years and 3 months. And at the top, the red line is the US yield on the 10-year treasury. And you can see it's way high above the green and the blue line. The green line is the German yield on their 10-year, which is today at about 0.19%. And the Japanese 10-year bond is yielding 0.02% right now. 2 basis points. Germany's giving you 19 basis points, and the US is going to give you 175 basis points. So the question has to be, what moves, right? Does the German and the Japanese yield move higher to meet the US yield? Or does the US yield have to come down? And will the US yield go negative for the 10-year? Things are not good when you have negative interest rates, because people are saying, you know what, I don't know, just give me my money back. Even if I don't make anything, I just want it back. And that's what's going on right now. And when people do that, it's because they're concerned about the future. There is no central control over the stock market. Sorry, Chinese government, you can't have central control over it. Sorry, I know you're not elected. I know you just put yourselves in there. But this will be interesting to see how you rule, and it is really ruling there, over the next 2 decades when you can't control the stock market. But that's where we are today. It may not be the market we want, but this is the market we have. This is an unstable, unpredictable market, both in stocks and bonds and currencies and commodities. That's pretty unstable to have that much instability in all those different asset classes. But that's where we are today. Now, the question is, what is the takeaway? How do you make sense of this? And what should you be doing with your money? So I'll answer it a couple ways. So the first thing is, what do negative rates mean? Now, I'm not predicting that the US 10-year has to go negative, though it's very likely that if the German and the Japanese rates stay negative, that's going to really create or carve out or shovel away the path of least resistance for the 10-year treasury yield to go lower. Whether it actually goes negative, I don't know. But there's a couple takeaways. And this first one I want to give you is not on the screen. The first takeaway is, if you own a home and you have a mortgage, over the next year or two, this will be the time to refinance that mortgage. If you live in Japan or Germany, you may want to start thinking about refinancing your mortgage now. I don't know how mortgages work in those 2 countries, but for at least US-based real estate, you want to start thinking about, hey, there's going to be a time in the future, this year, maybe 2017, where I can actually refinance my home for an even lower rate than I did last time. So that's one of the first takeaways. The second takeaway is, for rates to go negative, something must really be going wrong, right? Because people are basically saying, just give me my money back. I don't want to make anything from it. So that's just giving you a telltale sign of what hundreds of millions of free thinking people are thinking about as they look into their future. And they're saying, you know what, I'm going to play it safe right now. I need my money back. And part of the reason is because people have financial PTSD from 2008. And I have I talk to a lot of people about what's been going on with them with their finances over the last 15 years. And one of the things I've heard repeatedly from people is, yeah, 2000 was horrible, to lose half your money. But man, when I lost half my money again in 2008, that really had me start looking over my shoulder. And no one has used the phrase financial PTSD, but I think that's what people have now. They have this post-traumatic stress disorder because of 2008 and 2011, where the market fell 23%. And though the market is only down today about 12-ish% from its high, it's been going sideways for 18 months. It's very erratic, and we have negative interest rates. We have 3 times the amount of debt on this planet as we did in 2008. Most banks, major banks in Europe, have not cleaned up their balance sheets like the US have. Whether you like what the US did to help out the banks or not, at least they cleaned up their banks. And look, the financial sector is not looking good right now. right? So if trillions of dollars can't help this sector, what will? The last takeaway is this: negative rates will help gold. Gold's been in a downtrend for about 4 years. It's been in a solid downward trending channel for about 3 years, and it just broke out to the upside of that downward trending channel. That is very good news if you own gold or silver. Silver has also broken out of its 4-year down trending channel. So that is good news if you own gold and silver. Now, it has to stay out and it has to move higher. So far, it's acting really good. And I think what's going on is people are saying, you know what, let me just get a little bit of gold. Let me, if rates are negative and I'm going to get a little bit less back, then I might as well go buy an ounce of gold because I'm going to get all of that back at the end of the year. And you know what? Maybe gold, maybe it's time to take a look at gold. So over the last 6 weeks, as rates have started to really drop, gold has taken the exact opposite move and has started moving up and has broken out to the upside of its downward trending channel. And that's good news for anyone who has suffered through gold's. It hasn't fallen as badly as it fell in the 1970s, but it's been a much longer, drawn-out, painful correction from a time point of view. So gold is reacting, and people are starting to think like maybe I should go buy some gold. And in fact, the best-looking price charts for stocks this year are all precious metal stocks. Thank you, everyone, for being in my world. This is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck.